World Economic Outlook Update. Global Growth and Inflation Trends for 2025. World Economic Outlook Update, July 2025. Global Economy. Tenuous resilience amid persistent uncertainty. Global growth is projected at 3.0% for 2025 and 3.1% in 2026, an upward revision from the April 2025 World Economic Outlook. This reflects front-loading ahead of tariffs, lower effective tariff rates, better financial conditions, and fiscal expansion in some major jurisdictions. Global inflation is expected to fall, but U.S. inflation is predicted to stay above target. Downside risks from potentially higher tariffs, elevated uncertainty, and geopolitical tensions persist. Restoring confidence, predictability, and sustainability remains a key policy priority. IMF upgrades global growth forecast after Trump backtracks on tariffs. The IMF's optimistic outlook, a shift in global growth projections. The International Monetary Fund, IMF, has recently revised its predictions for global economic growth in 2025, presenting a more positive outlook. This adjustment is attributed to a weaker dollar, the resilience of financial systems amidst various economic challenges, and the U.S. government's decision to retract many of the tariffs that had been proposed earlier this year. On Tuesday, the IMF unveiled its updated World Economic Outlook, forecasting a global growth rate of 3% for 2025 and 3.1% for 2026. These figures represent an increase from the previous estimates of 2.8% and 3%, respectively, as reported in April. Why this matters? Since President Donald Trump took office in January, his sporadic threats of imposing high tariffs, along with the significant announcement of reciprocal duties in early April, have caused considerable unease in global markets. This has led to heightened fears of a potential economic downturn, not just in the United States, but around the world. Key insights. The IMF provided several compelling reasons for its upgraded economic outlook. One major factor is the considerably weakened dollar, which has created more monetary policy flexibility for emerging markets and developing economies. Pierre-Olivier, the IMF's chief economist, also pointed to proactive measures taken by various governments to stimulate growth, as well as a notable increase in exports to the U.S., as businesses rushed to ship goods ahead of anticipated tariffs. Additionally, the IMF highlighted the multiple pauses on tariffs since the April report, including 2 delays on Trump's reciprocal tariffs, which are set to conclude this week, and a May agreement between the U.S. and China that temporarily reduces rates until August 12. After an unprecedented rise in tariffs imposed on global trade in April, the United States has partially reversed its stance, delaying the implementation of higher tariffs for most of its trading partners, Gourinchas remarked during his address on Tuesday. As a result, the effective U.S. tariff rate underlying these new projections has dropped to 17.3%, down from 24.4% in April. Penelope Goldberg, a Yale University economics professor and former chief economist at the World Bank, noted, "One reason growth has remained robust is that the policies announced in April were never fully enacted. This doesn't imply that economists' warnings were unfounded. Often, our role is to sound the alarm in hopes that policymakers will take action. In this instance, while it may not be entirely accurate to say the U.S. government is directly responding to economic experts, it is certainly reacting to the pressures from financial markets." Most countries included in the IMF's projections have experienced a slight upgrade in growth expectations compared to the April report. The U.S. has seen a modest increase of 0.1% for this year, while China has received a more significant upward revision of 0.8%. Despite these positive developments, Gourinchas cautioned that tariffs remain at historically high levels and global policy continues to be highly unpredictable. With only a handful of nations having established comprehensive trade agreements, he added that while the resilience of global markets in the face of tariffs is encouraging, it remains fragile. The projected global growth rates of 3% for 2025 and 3.1% for 2026 still fall short of the 3.3% forecasted for both years back in January, prior to Trump's return to office. What experts are saying. Pierre-Olivier, the IMF's economic counselor and director of the research department, stated, "While the trade shock may turn out to be less severe than initially anticipated, it is still significant, and evidence is accumulating that it is adversely affecting the global economy." He further warned, "Without comprehensive trade agreements, the ongoing uncertainty surrounding tariffs could increasingly hinder investment and economic activity." Moreover, while the front-loading of exports has bolstered global activity thus far, companies may find themselves vulnerable if the anticipated demand for their stockpiled goods fails to materialize. Former Commerce Secretary Wilbur Ross characterized the administration's tariff rollbacks as merely part of the usual give and take in trade negotiations. He explained, "The very fact that Trump put these tariffs up for negotiation indicates that there was some flexibility in the original proposal." Goldberg added, "If tariffs stabilize in the 15 to 20% range, I wouldn't expect to see dramatic short-term impacts on the U.S. economy. However, there's a significant political cost involved, especially since many of these tariffs target long-standing U.S. allies. The ramifications of this cost will likely become apparent over time." She continued, "Even if tariffs increase further, I don't foresee major economic shifts in 2025. It's crucial to differentiate between short-term and long-term effects. In the short term, most countries are adopting practical strategies, opting to negotiate with the U.S. rather than retaliating. In the long run, a more rational response may involve gradually distancing themselves from the U.S. and seeking alternative trade partners globally." What lies ahead? So far, the U.S. has managed to secure a few trade agreements, including those with Indonesia, Japan, and most recently, the European Union. For the remaining countries that were subjected to reciprocal tariffs on April 2nd, the White House has set an August 1 deadline for the resumption of these tariffs, along with some new, higher duties on Canada and Mexico. Meanwhile, the 90-day tariff truce between the U.S. and China, which was agreed upon in May, is set to expire on August 12th. Treasury Secretary Scott Bessent and U.S. President Trade Representative Jamieson Greer indicated this week that negotiations are progressing well and hinted at the possibility of extending the truce further. Newsweek reached out to the White House for comments outside of regular hours via email. Update 07-30-025, 10:40 a.m. ET. This article has been updated to include additional comments. IMF surprising economic forecast. What you need to know. In a world where economic uncertainty often dominates headlines, the IMF finds itself in an unusual position. The crises it predicts are not as severe as they could be. But here's the twist. What if the global economy needed a bigger crisis to truly expose underlying vulnerabilities? London, July 30, Reuters. The global economy has managed to avoid complete chaos in 2025, which might come as either a relief or a source of anxiety, depending on your perspective. Following months of turbulence sparked by abrupt shifts in U.S. trade policies and tariff disputes, financial markets experienced a volatile yet short-lived roller coaster ride. Despite these disruptions, the International Monetary Fund (IMF) has concluded that global growth and inflation remain relatively stable. While this may sound reassuring, it raises questions about whether the true risks are being underestimated. The IMF's latest report suggests that economic activity worldwide is still somewhat subdued compared to historical norms, with inflation slightly higher than ideal. However, these deviations fall within the margins of error for their mid-year forecasts. In fact, the IMF revised its earlier projections upward, estimating global growth at 3.0% for this year and 3.1% for next year. Only marginally slower than 2024's pace, but precisely in line with the average growth rate over the past decade. Virtually every major economy, saw a slight improvement in its outlook, except Japan, whose forecast for 2026 was trimmed just a touch. To put things into perspective, this outcome is far from the catastrophic shock many anticipated earlier in the year, when fears of an escalating trade war loomed large. Even back then, the IMF's predictions fell short of signaling a deep recession. That said, forecasting amidst shifting trade policies has proven challenging for everyone, including the IMF. Although recent developments have clarified Washington's intentions to some extent, the issue of tariffs remained unresolved while the fund finalized its forecasts. What makes this situation particularly intriguing and perhaps uncomfortable for an institution like the IMF is how little immediate fallout has resulted from the United States' dramatic pivot toward protectionism. This unilateral move contradicts decades of multilateral agreements and conventions championed by organizations like the IMF. For an entity that has long promoted the so-called Washington Consensus, which emphasizes free and open trade, the absence of significant repercussions feels unsettling. Could this undermine the very principles the IMF has stood for? Explaining the seemingly mild impact of recent events, IMF chief economist Pierre-Olivier pointed out that a sharp decline in the value of the dollar helped improve the overall global economic picture. Additionally, he highlighted several complicating factors, such as companies rushing to import goods before tariffs took effect, fiscal stimulus measures in Europe, tax cuts in the U.S., and declining energy prices worldwide. Yet Gorinchas cautioned against complacency, noting that even though the worst-case scenario had been avoided, a 17% effective U.S. tariff rate would continue to create challenges globally. Back in April, the assumed rate was a staggering 24%. Different scenarios outlined by the IMF underscore potential risks that could emerge down the road. However, the resilience of financial markets since April hints at the limited macroeconomic costs of President Donald Trump's tariff strategy thus far. By using tariffs as a tool to raise revenue and offset income tax reductions, Trump's approach appears to have worked without causing widespread disruption, at least for now. This lack of visible consequences poses a dilemma for the IMF. After years of advocating for free trade as a cornerstone of economic progress and stability, the muted response to such a breach of orthodoxy weakens its argument both domestically and internationally. Moreover, other pillars of the Washington Consensus, like central bank independence or the use of capital controls, are also being reevaluated in light of current trends. For instance, Trump has already challenged the principle of central bank independence, pushing for interest rate cuts despite conventional wisdom advising otherwise. In response, the IMF reiterated its stance on the importance of keeping central banks autonomous. As Gorinchas stated, central bank independence is a core component of macroeconomic stability. It's one of the lessons we've learned the hard way over the last 4 decades. Much like the difficulty British pro-European politicians faced in pinpointing the exact damage caused by the Brexit referendum immediately after the vote, the full cost of dismantling established global policy frameworks may take years to materialize. Instead of a sudden crash, the effects could unfold gradually, creating a slow-burning crisis rather than an explosive one. So, what does all this mean for the IMF and its supporters who advocate for an open, rules-based multilateral order? Ironically, a more pronounced crisis, one larger than the one currently unfolding or predicted, might actually serve their cause better in the long run. A deeper reckoning could highlight the importance of adhering to multilateral principles and strengthen the case for reform. But here's where it gets controversial. Should institutions like the IMF adapt their models to account for new realities, or should they double down on traditional principles? And what happens if the world continues down this path of economic nationalism without facing immediate consequences? These are pressing questions worth exploring further. What do you think? Share your thoughts in the comments below.